Welcome, everyone. We'll get started in just a minute. Welcome again. My name is Lindsay Goldman, CEO of Grantmakers in Aging. We are a national membership organization that serves as a network and resource for funders and a champion for aging-related issues and investments. With over 100 members, we work to mobilize the social, intellectual, and financial capital required to improve the experience of aging now and in the future. Today's webinar is co-hosted by our partners at Grantmakers in Health, a nonprofit educational organization dedicated to helping foundations, corporate giving programs, and other philanthropic organizations improve the health of all people. This program is sponsored by Archstone Foundation, one of GIA's founding members, whose mission is to improve the health and well-being of older Californians and their caregivers. Both GIA and GIH are committed to providing our members with strategies and resources to enhance our grant-making practice. Impact investing is one tool that's increasingly being used to achieve philanthropic goals and bring innovation to scale. So with Archstone's support, we commissioned Avivar Capital, led by Lisa Richter, to survey our network to learn how and where impact investing is being done. This webinar is an outgrowth of Lisa's research. Her findings will also be summarized in GIA's new guide to impact investing for aging philanthropy, which will be released later this summer. We'll have time for questions towards the end of our hour today, so you can submit any questions throughout the program using the question box in your control panel. If you have comments to share during the presentations, please use the chat box. We will be making today's slides and audio available, so no need for copious notes. Just watch for an email to be sent within a few days. And now I'd like to turn it over to Chris Langston, President and CEO of Archstone Foundation. Chris?
Thank you very much, Lindsay. It's a pleasure to be able to sponsor this. We are very proud of our relationship with Grantmakers in Aging and Grantmakers in Health, and very pleased at this work that we're able to bring to you all today, particularly at a time like this when our endowment values and the general public markets are down. I think we're all probably racking our brains for innovative ways that we can increase our impact and we can advance our missions, even when conventional grant-making funds may be suddenly rather scarce. Even without that kind of driver, as someone who has sat in finance committee meetings for many, many years and heard about the creative ways that capital is deployed to try to advance the economy, to meet people's needs, I think trying to see what parts of those tools and techniques that we might bring into our mission-related work has always fascinated me. I have to say, though, that I'm still looking for that just right opportunity, like some of you. And so I hope that today's conversation will be a stimulus and help us all learn together. So on that note, we have a great panel assembled for you all today. We have Lisa Hiller, Vice President of Administration at Bader Philanthropies. We have Chris Crothers, Director of Impact Investing at Jesse Duvall DuPont Fund. And we have Lisa Richter, Managing Partner at Avivar Capital. So Lisa will be starting off the presentations and giving us some background and a framework to try to understand and interpret some of the activity in the field. Thank you all very, very much. I look forward to your presentations.
Thank you so much, Chris, and thank you, Lindsay, and Grantmakers in Aging for championing this work. It is such a delight to learn more about how GIA's members and partners are using the tool of impact investing to help ensure communities that promote healthy aging for all. Next slide, please. And we appreciate Archstone Foundation's support in the effort. We're going to move quickly through a refresher, as Chris said, and then enter into a discussion with our panelists that really focus on how is it that they find impact investing important to their work? Why do they do it? What do they focus on? And what was their process like for getting started, and what guidance do they have for GIA members? Next slide, please. I will move quickly through the slides, but know, as Chris mentioned, that you'll have a recording and can always refer back. Next slide, please. So to dig right into the refresher, impact investing is part of a larger toolkit of approaches to investing that incorporate social and/or financial investment decision-making criteria. And some of the terms that are bandied about include SRI, which today means sustainable and responsible and impact investing. It's become an all-inclusive term. Those who have studied the field for years know that it had an earlier incarnation called socially responsible investing, which meant excluding investments that an investor might find objectionable from a social standpoint, but more inclusive today. ESG, hard to open a newspaper without seeing that today. It refers to the incorporation of environmental, social, and governance criteria into investment decision-making. And SRI and ESG are largely the province of investors that are focused in the public market, so publicly traded stocks and bonds, and that's what we have over on the left-hand side of this toolkit diagram. Investors that are managing stock and bond portfolios use screening according to SRI and ESG criteria, and also shareholder advocacy, which we'll hear more about in a moment. But today's webinar and the initial work with GIA is more focused on the right-hand side, proactive investing, impact investing, where the investor is usually making specific investments to drive particular desired social outcomes. And under impact investing, we have mission-related investing, or MRI. That's a term of art, and it refers to investments that are typically seeking a market rate of return. That's called the first bottom line, but also a double or triple bottom line of simultaneously driving social and/or environmental benefit. That's MRI. PRI, or program-related investing, as we'll hear, are investments that are made with a primary purpose of advancing charitable goals. And we'll hear much more about all of that in a moment. Next slide, please. So just as a little further background for you, summarizing the different techniques that investors are using today, and we can go to the next slide. And I'm going to move through this one very quickly because we'll then dig down on impact investing. The broad toolkit of social investing, and we're going through this because some investors get started by working with their stocks and bonds portfolios, while we think many more get started with the private market impact investing. But just to lay out the landscape for all of it, negative or exclusionary screening out, for example, of tobacco stocks. Foundations often do this because they don't want holdings that might be at cross purposes with their grant objectives, such as promoting health. Others now, increasingly in recent decades, are doing proactive screening in of publicly traded stocks or bonds that they consider best in class in a sector, such as McKnight's portfolio of publicly traded companies that are pursuing low carbon solutions to general business strategies. ESG integration, whereby investors are bringing environmental, social, and governance screens into all of their investment decision-making. Sustainability themed investing, which usually means incorporating some kind of environmentally sustainable goal into the approach, but can also refer to approaches that promote longevity and sustainability, financial sustainability of strategies. And then we get to impact investing here, which, as I said, is typically in the private markets. So private debt, private equity, including venture capital, potentially real estate investments, where the investor is really trying to target some social impact and making the investment to drive that impact. Shareholder activism or shareholder engagement, it ties back to the publicly traded stocks and refers to the owner voting proxies or otherwise engaging with corporations to try to move those corporations toward more positive social and environmental practices. Next slide, please. So now digging down on impact investing, it's typically defined as investing into companies, organizations, and funds, but we say it could also be real estate projects with the intention to generate measurable social and environmental impact alongside a financial return. Let me begin by saying that financial return could be anything from a return of the principal invested, so no interest or dividends, very low financial return, to a market rate of return. And we see this set out in the diagram. On the left, program-related investments, which, as I said, are primarily for a charitable purpose. And there, the investment is typically made on concessionary terms, below market rate interest or other concessionary terms of an equity investment, or perhaps that investment accepts more risk than normal in order to drive a charitable purpose, to drive social outcomes that would not happen but for, which are often used terms in our field, but for the flexible terms of that investment. And then over on the right-hand side is the mission-related investment, or MRI, that's seeking a market rate of return while also driving social and or environmental benefits. Before we leave this slide, we want to make sure that you understand that impact investments can be in any asset class or investment structure. So you see here, it's easiest to see on the right, you see cash, fixed income securities, public equities, and alternatives. Those are all the asset classes that a conventional investor will use, but we can use those and drive social and or charitable purpose. The investments can have any financial return, as I just described, but it's very important, I think, for many of us in the field that we're able to achieve the financial return that we're after, whether that's concessionary or market rate, in order to demonstrate the viability of these techniques. And we often say the same fiduciary care of any institutional investment, again, because we're trying to show that communities, populations, and sectors, innovative sectors that may not have had access to capital before, in fact, can take on that capital and repay while also generating their important social returns. Next slide, please. So a slightly deeper dive on PRI, or program-related investment. This is a type of investment defined specifically for private foundations by the IRS, but also adapted by others. The primary purpose is charitable, as I said. No significant purpose is the generation of income or appreciation of capital. In other words, we're not doing this to maximize return, and no purpose is influencing legislation or lobbying. Next slide, please. And now just think for a moment about what makes a feasible impact investment. And another way of thinking about this is, what is the difference between an investment and a grant? An impact investment. Both start with trying to drive impact as a primary goal. And so we're looking for mission alignment and program related alignment, which we often call the impact thesis. But with an investment, we're also looking for an investment thesis, some evidence or theory that causes us to believe that investment will repay. So is there a predictable cash flow associated with it, which could be revenues earned by a company, let's say a corner grocery store in a food desert. It could be cash flows coming for government, such as reimbursements to a federally qualified health center, but it also could be pledged grants. So predictable cash flow that allows us us to believe the investment will repay. That could also come from savings, such as energy savings from installing energy efficiency equipment. It could come from refinancing for a real estate project that has early stage pre-development financing, then construction financing, then a permanent mortgage. And each of those loans takes out the prior loan, takes out or refinances, and that enables those early stage investors to have confidence they'll be repaid. Finally, if an equity investment goes, or I'm sorry, an impact investment goes into a for-profit company, then the repayment is going to come out of the growth and success of the company. So we look for both the social and financial return. And there's a beloved saying in the field that impact investments are not mean grants or bad loans. They're done because we think it's the appropriate way to help the investee scale their benefits. Next slide, please. I'm going to pick up my scale a bit, my pace, so that we can get through everything here, but very quickly, there are many reasons why impact investors choose to use the tool. A major one is to access the large amounts of capital outside of grants budgets, and we'll hear more from our practitioners in a moment. Next slide, please. This field, even though it feels new and emerging now, has actually been in development since the invention of PRI by the Ford Foundation in the 1960s. And every decade has seen innovation that brings impact investing to a larger sphere of impact. Usually there's an interplay between other philanthropic activities like the support, grant making support for community-based organizations, plus conducive policy that is the backdrop for innovation in the capital markets that allows our field to continue to grow and thrive. Next slide, please. One of the great benefits of impact investing is enlarging the partners with which foundations work to mobilize resources for driving change, and we see a group of them here. Not everybody comes with the same motivation, but we find the common purpose that allows for co-investment. Next slide, please. This trend has been growing significantly in recent decades. Next slide, please. And a significant part of the investing is coming down into the communities where we're trying to create conditions for healthy aging. Next slide, please. Wall Street has not failed to notice. It's hard to find a Wall Street bank without a marquee on impact investing nowadays. Next slide, please. And then just very, very briefly, I think the opportunity for foundations and like-minded investors that are thinking about using the tool is to take the ideas and potential of impact investing and move them into action. And we typically find that that's a process with 4 high-level tasks: planning, creating investment policy, creating process and procedures, and then what we call portfolio management, which is making everything happen and tying it back to the institution's higher level goals. We've never met an investor that does all this in a linear process, but these are the tasks we see over time, and we look forward to hearing how our practitioners today have followed their path. Next slide, please. Applying this to the important vision of Grantmakers in Aging, one of the reference points that GIA uses is the 8 domains of livability created by AARP. And you see them here. And for those who may not be as intensely focused on healthy aging, I think we can agree that these are principles or guideposts that we would look for in any healthy community. And in the course of doing this report, Abivar added a 9th, safety and security. And if we go on to the next slide, what we've done is we've taken those 8 domains of livability and we have spread them out on a spectrum of needed supports for healthy aging, from protection out to what is needed in a community for full and healthy engagement of all. And you'll see for each of the domains, we've listed a number of impact investing strategies, all of which we've seen tested and demonstrated in communities across the country. Now, I will say, when we think about the idea of having the potential for repayment, some of these are very straightforward. So housing easily generates repayment because there is rental income from housing, or there may be sale income when a developer develops home ownership opportunities and sells the house. But for others like respect and social inclusion, there's not necessarily that predictable cash flow there. We still wanted to include all the domains because we think that some of them are important overlays, not to the what that's being financed, but to the how, the process that makes the impact investment more inclusive for all. Next slide, please. So that brings me to the end of our refresher and gives us the opportunity to turn to our two practitioners today who we're delighted to welcome, Lisa Hiller of Bader Philanthropies and Chris Crothers from Jesse Ball DuPont Fund. And we're going to begin with an open-ended question for each, and I'll start with Lisa. If you could share with us, Lisa, how Bader thinks of the importance of impact investing to your work, and we'll move to the next slide, which is profiles one of the investments that you've made, but welcome you to just share your perspective, please.
Great, thanks, Lisa. First of all, I just want to thank you for all the work you've done in the arena. We've worked together for many years, and I think that the world of impact investing has expanded greatly because of your efforts. So I wanted to thank you. And also GIA for understanding that this is a very important possibility to help in the area of aging, healthy aging. So we at Bader Philanthropies, we were one of the earlier PRI makers, and we started in 2000, and we did it because we felt that it would be an extra tool, another tool in our philanthropic toolbox. Alzheimer's and aging, healthy aging now we call it, is a keystone program area since our inception as a foundation. So that's not the only area that we've made PRIs in, but we certainly do a lot of PRIs related to that program area. We've been doing it since then. We've made 50 PRIs. We've made all kinds, loans, loan guarantees, equity investments, equity loans, and credit enhancements, which have lost popularity over the period of time, but I bet we'll have a resurgence in our current economy. So that is primarily how we got started. We have made, we felt that it was important to expand our toolbox because some projects just don't need grant dollars. They need other things. Some projects need both grant dollars and investment dollars. And we felt that we could leverage our grant making by bringing into the investing world other players, such as public and private. And that has made, yes, Lisa, thank you for putting in the chat that I wasn't just speaking about guarantees. There are other instruments of credit enhancement that we have utilized that have been very effective, such as linked deposits and things like that, which are very helpful in reducing debt and such. The other thing that PRIs we have found has done is it's built infrastructure in our organizations that are partners. We only really generally make program rate investments to our grantees. So because we feel that we know them better. And of course that they're not used to that in many cases, and we have to help guide them. But I think that it's been very useful for them as well. And then we did now lately, what we've been trying to do is more guarantee work and loans relating to government reimbursement of services provided by nonprofits and sort of giving them some space to pay for their folks for providing services before the government in its bureaucratic way pays them their approved funding. So if you want, I can talk a little bit more about the example here.
I think that would be great, Lisa. Maybe we could touch on your 3 examples, and then I'll flip over to Chris, and then we'll flip back to you in a moment.
So from the beginning, I would say maybe 4 or 5 years into our program-led investing program, we started funding. We've done 3 of these projects. Clark Square is one of them, was one of our first. And that's a very good example of bringing together affordable rentals for seniors. We called them seniors then, 55 or older. It was basically some assisted living services, but it was providing housing for, and it was in a mixed situation. It was intergenerational. It was not just for older adults. It was very successful. And what was successful about it is also that we had a private developer in the deal, and there were WIDA credits in the deal. And this is what we have found to be very good for construction projects or renovation projects like this. We've had 2 or 3 of these. Additionally, do you want to flip to the next slide?
We can, and I'll say WIDA is the housing finance agency in the state of Wisconsin, and a great conduit for low-income housing tax credits and other supports.
Right. And this is another situation. This one I want to touch on is, and I want to bring this up, is we didn't only directly make loans. We have developed, since the time we started, where there were very few community development finance institutions. I'm trying not to use too many of these initial things that confuse people. CDFIs, we call them, but they're basically community banks. They have the interest of the community at heart. Sort of a second generation from what banks used to do as community CRAs. What's the translation?
Community Reinvestment Act.
Thank you. Very great. And basically, these institutions now have grown in our state. There was really none when we started, and this was one of the first ones. We found this, actually, they were situated. IFF is the Illinois Facilities Fund. They really are an Illinois organization, but they moved sort of into Wisconsin. And they basically, what we did, we made a loan to them to do many projects, such as the Village Square Grand Family Apartments bill, or many others, St. Catherine's housing. And basically these were all for either intergenerational or elderly, again, providing housing and services. And we partnered with IFF on this one, but we've partnered with other CDFIs since then in many ways. Mostly we have several in Wisconsin. I don't even need to name them, but they have them all over this in every area, and it's been a very successful partnership. And I think that we really have to support our CDFIs in this arena, because they are they're taking a lot of the risks. You can also guarantee.
That's wonderful. We have one more example, Lisa, which in fact does involve Forward Community Investments,
Right.
which is another CDFI, Community Development Financial Institution. So next slide, please. And we were excited in the research because we could see that Beta was financing not only housing with services enriched, but also other kinds of institutions that are essential to promoting healthy aging.
Right. St. Anne Center has been a partner of ours from the beginning in our Alzheimer's and aging area. We've given them many, many, many grants. And in this case, we made a loan to FCI, Forward Community Investments, which is really out of the state capital of Madison, in Madison, Wisconsin. But they do a lot of work now in the urban areas. And this isn't the first of St. Anne centers, but this is their north side, or their, what I would call more of their central city facility, and very, very needed here in Milwaukee, in the Milwaukee area. And we actually, and this is something that it's a great way to get started with PRIs, and that would be to basically make a loan to FCI to do a revolving loan fund. And that is this is one of the groups, one of the places that FCI thereby then made a loan for their expansion.
Tremendous. Thank you, Lisa. Next slide, please. And we will flip over to introduce Chris Crothers from Jesse Ball DuPont Fund. And I'm pleased to say that I discovered Chris by Googling and finding mention of the foundation's impact investing. So a big shout out for all foundations that post on their website about their activities, and was delighted to see that one of the investments was 2OY that had a really robust set of services for seniors, but learned that the foundation is doing much more. So Chris, it's interesting that we're hearing from Lisa Hiller, a place-based investor, primarily in Milwaukee, but also in greater Wisconsin. And you are also place-based in a couple of locations, and would love to hear about how impact investing is helping the foundation advance its mission.
Absolutely. So thanks for inviting me, Lisa, and I appreciate GIA for having us. The Jessie Bell DuPont Fund, we really moved into impact investing. We were interested in it prior to the recession. The recession really drove it home to our trustees that, after losing $90 million in 90 days and the impact that that was going to have on our grant making power going forward, they really asked the question, what else could we be doing? Right? Could we be doing more? Could we be doing better with the resources at our disposal? So, of course, they looked at the 95% that's being invested as a private foundation. 5% goes out the door in grants, and 95% sits in the hands of advisors, and they invest it so we can exist into perpetuity. So we really started looking at that 95%. And I think as a standard, what I've heard, a lot of foundations will kind of dip their toes into impact investing by moving into the PRI space. So we, again, like a lot of foundations, we sought folks out in the out in the environment who were doing great work. And we consulted with a gentleman named Tom Miller, who used to be with Ford Foundation back in the day. And he advised us how to kind of develop this program. And we started with program-related investments, mostly into community development financial institutions. It's important to kind of note that the Jessie Bell DuPont Fund is a little unusual, or maybe somewhat unique in the field, because our donor left restrictions on her will that basically said we could support the organizations she supported through our grant making between 1960 and 1964, which limited us to 318 organizations who could receive grants. And if you look at the communities that we serve, where we have clusters of these grantees, whether it's Jacksonville, Florida, the northern neck of Virginia, Wilmington, Delaware, Port St. Joe, Florida, we didn't have robust affordable housing grantees. And each one of those communities was experiencing an affordable housing crisis. So by using program-related investments and using the endowments, we were able to actually move outside of our grant making and complement what we were able to do with our grants in our communities, using a much larger pool of money to be able to invest in things that were prior out of our reach, like affordable housing. So we moved with a full head of steam into program-related investments in the community development financial institutions. After we felt pretty grounded in that, we started moving to direct PRIs. This YMCA example is an example of one. Our largest PRI to date has been the building that we're in downtown Jacksonville. This grant, or this PRI, allowed the YMCA to move into this building and overall cut their operating costs and still receive a office space for their back office and whatnot, but their operating costs were declined extensively as a result of this investment. And then we were making add-on investments as well as our grants to the YMCA to kind of support the work that they were doing there. Today, we've expanded beyond that to move into mission-related investments.
And Chris, if I might interrupt you for one section, I think I would ask to go to the next slide, please, which will be a backdrop for your comments. Thank you.
Great, thank you. So we moved into mission-related investing in the sense that we have a thesis that says, we believe that we can make a market rate return and still do good in the world if we're paying attention and we're intentional. This is a snapshot from our website. The other thing we feel strongly about is transparency. We feel like since we've been we're allowed to have a 501c3 status, that we should be as transparent as possible. So we have all of our impact investments listed, and we try to break down by asset class and share as close to date as possible. And we're moving into now trying to share what does our investments look like in terms of equity. So how much money is invested with fund managers of color? How much are we trying to move into communities of color? We're trying to actually track that over time. Our mission related investments, as you can kind of see here, and our program related investments, they're in this pie chart to the my left on the screen. So about roughly 40% of our endowment is invested in ESG screened investments, PRIs, or direct investments, as well as I believe we have a colleague from Kresge that put a note in, as well as we're part of the Community Investment Guarantee Pool that was a brainchild out of Kresge. So we're kind of all over the map, and we really focus our grant making and our impact investments primarily in the areas of equity and placemaking. So you could see that even though we're not a specific funder or investor in issues that affect seniors, there's ancillary overlap between many of our investments and our grants.
That's so helpful. And if we could flip to the next slide once more, please. I really admire the way, because of your commitment to transparency, Chris, the foundation has posted all of your impact investments according to amount, investment type, period, geography served. So place often plays an important role for many impact investors, and then the asset class. And any comments you might want to share about this? This is just a tiny selection out of your full roster that's posted.
Right. So I think this is a best practice. We're not the only foundations that offer this, but I feel like it's two things. One, again, it's important to be transparent, but two, I think that as an impact investor in communities where there aren't a lot of other impact investors, that this kind of shows an example of one, who you can invest in and why and how. So it helps to also kind of grease the wheel and maybe helping other folks become more comfortable or identify organizations that they may want to look at if they're interested in moving into the impact investing space.
Wonderful. I think we could actually take the slides down now. We'll have a little more discussion with Lisa and Chris, and then we'll open it up for questions and comments. The next thing we'd like to talk about briefly is we said the focus of your impact investing, but I think that we got a pretty good feel for that. If you would not mind giving us a feel for sort of the practical aspects of how you got started. Did the impetus come from the board? Did it come from staff? Did it come from maybe an emergency loan request? And Lisa, I would start with you.
Well, we had somebody approach one of our program officers in the area of family and children at the time, right, pretty close, maybe 10 years after we became a foundation, and with a loan deal, and we didn't know what we were doing. So we thought it would be pretty good to try it. So we tried this one deal, and then we did what Chris was just describing. We went around, we met with Heron, and we met with a bunch of other foundations that were doing this work, this PRI work. At that time, mission investing was not really a big deal. It wasn't the thing. PRIs were the thing in the beginning. And so we went around and we got a lot of education. We said, well, this one worked pretty well. We think this is a great idea. And so then the board was very excited about it. Not about every single one we tried, but they were very excited about the concept of expanding and doing these kind of things. And I think that we tried all kinds of things. We did an equity investment for low and minority businesses. I think it was like one of the first of its kind, to GGC, and it really made a huge difference, very successful. And we feel like we're owners, we have shares in minority businesses. I don't know how many foundations, that we feel good about that. And it's been very successful, so successful that we had to take it out of our PRI portfolio, put it in our investment portfolio because it was too successful. So that is how we to grow in over these past. When we first started, there was a period where we thought we were going to sunset, so we were making our loans in very constricted terms, and now we have expanded actually, so that we are not going to sunset, and now we've really picked up our PRI portfolio.
Fantastic. And Lisa, I know that that you mentioned that you weren't sure what you were doing at first, but I believe always have worked with an attorney who helped you sort of think through investment structures, document investments, and so on. Could you just take a moment to talk about the importance of having great legal support on this?
Yeah. So that's the thing. I have talked about the nuts and bolts of doing PRIs for many years now. I love PRIs. I'm very supportive of it and excited. I'm a big champion. But we needed, and as a result, we do like to share some of the work that we did to get this going. We wanted to integrate PRIs right into our regular grant making process. What I found when I went around the country and talked and went to conferences and such was most PRIs were being made off of Excel spreadsheets, and they weren't being easily tracked the way the grants were. So we have now created incorporated all of our PRI making into our grants management system online. So they go through the same process. In terms of creating in PRIs, I don't know, most people don't understand them in the actual nonprofit arena. So we had a wonderful, we still have an exempt organization attorney who created, basically when you do a business, all these business related agreements, there's nothing about the rules that the IRS says have to go in there for private foundations. So she was wonderful about taking these agreements and adding that stuff in. And we've shared that. We are happy to share those sample documents, all kinds, term loan agreements, mortgages, all those kind of things that you would do, guarantees, all those kind of things that still have to incorporate the IRS rules for private foundations. And so she's done that and has helped us significantly. And in the beginning, there was a lot of lawyering, not just her. But then now when you do a number of these deals, not that they look exactly the same, but you can put your arms around them and you can sort of, there's a reduction in attorney's fees related to these as you go forward. In the beginning, it's a little, obviously you need more due diligence. But recently I worked with another organization here in Wisconsin who's making their first PRI, and we were so excited because there haven't been too many. And she called me up and she said, do you have an agreement that isn't 52 pages long? Because my people are not going to understand this. And so we helped her out by giving her one of ours, which is 20 pages long, but not 52 pages long. So yes, it's very, very important. And it's important to build your staff also. We didn't know what we were doing, but we've all been learned, educated. If we're doing underwriting, we send that out. We work with our CDFIs to actually do the underwriting on many of the deals, either if we're working with them or we're not working with them. We were actually on the deal. They'll do the underwriting for us. We'll pay them to do the underwriting. So it's worth it too. And that makes a big difference. And we have a very good record.
That's tremendous. We'll come back to you on the guarantees, but Chris, would love to hear a little bit about how you got started and what was the interplay between board and staff and so on.
And so I think I mentioned a little bit earlier, I may have jumped the question, but it was really the recession. We had known about program-related investments. There was interest in program-related investments at the time, but then again, the recession hit and we were like, we've got to do more. So that was the impetus for us to move into it. And it was, again, the focus of our program-related investments at that point in time, beyond just trying to do more in our communities, was to move around those restrictions that were in the will. So again, as we were looking down, Jacksonville, Florida is a great example. We, after the recession, we were a sand state. affordable housing was taking a huge hit here, and we had no way to play. We had no way to support through our grant making. So we were actually able to go through our council, right? So we have trust attorneys that tell us what we can do and what we can't do. And very similar to Lisa, they were side by side with us the whole way to get us started, to make sure that we weren't wandering off in the back 40 doing something wrong. But once we got, figured everything out, we started moving forward, we're able to navigate the will, stay in compliance, but go outside of what Mrs. DuPont had originally done just through her restrictions around grant making. And that allowed us to go deeper into the affordable housing space. And when I say go deeper into the affordable housing space, for instance, we have a LISC affiliate here in Jacksonville. It's the last LISC affiliate in the state of Florida. We helped bring them to Jacksonville 20 years ago. And we were talking earlier offline about how do you pull grants and your PRIs together. That's an example for us. We provided operating support for LISC so that they stay in Jacksonville and they're focused in Jacksonville, and they bring National's balance sheet to Jacksonville. And we're providing operating support through grants that way. But then we're also invested in the loan pool with them. So our money is actually, because of the trust, we can go through the endowment and invest in LISC, and then the money that normally would not have been able to flow into the community for things like affordable housing, community facilities, and federally qualified health centers, for example, or Head Start, or even clean energy. Those things were opened up to us in a way that we had never been able to invest in or support before.
Thank you so much. And your board apparently was comfortable with this. Was there any resistance at the board level?
No, there wasn't resistance. There was an openness to do something. But there was prudence, right? So luckily we didn't have to sell it, or do a hard sell on it, but they were very prudent. And again, I think we were lucky that we had connections and had met Tom Miller, and he came in and gave us great advice, and we were able to get started, and they got very comfortable. And I think, again, when you look at the risk of investing in CDFIs, it was a very comfortable, nice, easy place to start because the risk was so low. And then they got more confidence and more comfortable. And it was like, well, this is great. And I remember the investment performance reports before we really started doing impact investing. And literally everybody was paying attention, but it was very matter of fact. And then once we really started going deep and reporting on the outcomes from the program-related investment, there was a little bit of a different flavor to our investment reporting. The trustees got very engaged. They were like, well, how many affordable units have we been able to support now? And how many are, 80% AMI? And are we supporting, workforce development in some of these communities around affordable housing? So there was an excitement that came out of it that was very similar to the excitement they brought to our grant making. But now it was on the investment side. So I thought that was a great change for us.
That's tremendous. And I know that we want to get to questions from the audience. So I think I'm going to actually do that, but I may come back to each of you with some further questions as well. You touched on something, Chris, right there that ties to one of the questions from participants. The question is from Lindsay. How is or will the recent downturn of the stock market and rising interest rates affect impact investing? And Chris, you were musing on that before the call. Maybe you could say a few words first.
So interestingly enough, I am living this today, right? So luckily we've been able to hit our ceiling. So we set a ceiling on our program-related investment pool, and luckily we've already hit the ceiling. So that's a good problem to have. But now we have so many more opportunities that we can get into, and they're what I would consider very high impact opportunities. So I'm at my ceiling. We have these opportunities. I'm kind of sitting here almost dead in the water about what I can do. So now I'm having conversations with the trustees that we need to increase the PRI ceiling so that we could do all these great things. And they're very open to the idea, but the pushback was, well, how are we going to pay for these in this down environment like today? So I'm actually working on a plan that's going to, that we're presenting next week to the trustees about how we can raise the limit for PRIs And one of the options that we're providing them, besides liquidating assets that may be underperforming at this point in time, right, which nobody wants to do and erode your grant making power for the long term, but what we're considering is taking a revolving loan so that we can have a lower interest loan. Maybe we'll go ahead and use that credit to fund the program related investments and wait for the endowment to come back, up, and then take those loans out over time. So that's one way we're managing the downturn in the market as a way to manage this and still continue to support our program related investments. But it can be a challenge when you're offering 1% loans and then you're looking at, say, 9% drop in fixed income, for instance, where we would normally liquidate to pay for a program-related investment.
That's super helpful. Lisa, you may have had the experience where the stock market is tanking, but you're actually getting loan repayments from some of your prior PRIs to help in the down market. Any thoughts about how impact investing can be helpful at those times? And you're on mute.
Yeah, that was an interesting period of time in the impact investing world. There weren't a lot of us. And in foundation world, there were a lot of foundations in our proximity who really had to cease their funding. They had to take a pause in funding, or they had to lower their funding, or they had to stop taking applications. There was a lot of that going on then. And we didn't have to do that because we had a pretty vital loan repayment going, and it just worked out. We were able to revolve some of that money. I also think that's really important, which was what I was alluding to before, in the market where credit enhancements can be very helpful to your grantees now as the interest rates rise. They don't really work very well when there's not a very high interest rate, but several of the things we've done lately have been to guarantee or to lower the debt of a nonprofit so that they can use those dollars for programming as versus paying back their loans that are a higher interest rate. And that's also another very good technique in this for the nonprofits. I'm not so worried about our stopping to fund. I think we're going to be okay. And we still have these payments coming in, so it might repeat itself. I don't know, but yeah, we don't have an endowment, so we don't really worry so much about jeopardizing that.
You bet. And I remember another saying from way back when, which is watch a PRI outperform the stock market, because there isn't the volatility. And so every now and then that 2 or 3% or even 1% loan starts looking very, very good. And the beauty of the relationship between the foundation and the investee is that the foundation can be patient and wait for that investee to repay.
That's very important. Yeah, that's an important idea.
I think that's part of the reason why repayment rates tend to be so very good on these loans. So Lisa, you mentioned
loan. We really used a lot of resources to lower the interest for the recipient. The IFS was a crazy, and we've done stuff with LISC also in the PRI thing. So that's great that we have something in common with Chris.
Yeah, absolutely. There are two other questions that I might answer sort of quickly. Cindy Lucha asks, PRIs to grantees, is this primarily loans or also essentially supporting the grantee to establish income producing programs that could, let's say, repay a loan? I think, Cindy, what I understood this to mean is that many foundations look at their grantee portfolio to find their potential PRI borrowers. And they may make tandem grants to help those organizations diversify their revenue sources so that they can better qualify for a loan. Lisa or Chris, would you want to add anything on that point?
We did just what you just said with the Center for Veterans Issues here in Wisconsin. We made a grant. They had a very large debt service, and we made a grant and a PRI loan directly to them. And that allowed them, again, to reduce their debt so that they could provide programming and housing, permanent and otherwise, for in their very different programs. They're doing great. Really
Yeah,
made
that's fabulous.
really
And,
made
and
a difference. Recently, it's a couple of years ago.
by the way, when you get the slide deck from today, there's some bonus slides in there, and there is a slide specifically on how grants can work in tandem with PRIs. And not only can they help lower the current debt burden, or interest expense of a PRI borrower, but they can also do things like fund the business plan to enable an organization to think about their strategy for taking on a PRI, et cetera. The next question is, how often are investments made directly versus through intermediaries? And I'll say that I don't think that is carefully tracked just for US PRI makers or US impact investors. But the preponderance of dollar amount of impact investing does go through funds, because usually those are bigger investments. And what we more often see is that, number one, some investors really only go through intermediaries because they can offer some tremendous benefits. Some start with intermediaries because it's a great way to learn by watching the intermediary partner, and then they begin to feel more confident doing a direct investment later because that gives them ability to better target impact in some cases. And then many, as I think is the case for both Lisa and Chris, continue to do both and will consider what's the best structure for a particular investment. And this is true for those who make both equity investments as well as debt investments or loans. Chris or Lisa, I don't know if you'd want to add any to that.
Yeah, we do both, as you say, and it does depend upon the deal. Like, I think one of the key things for people to understand, for organizations to understand when they're starting this, is just don't be in the deal alone.
Yeah.
I think that it's really helpful, even if you're providing the patient capital, because it really helps to have just the knowledge and the investment of the other organizations, whether it's CDFI or direct. Still, even in direct investments, it's really good to structure a deal, as I mentioned before, public-private. It helps you get more capital into the deal, but I think that I think that's really the critical thing. I do think there is an onus on foundations to help build CDFIs also. So I think that if you can do, and it's a great way to start. It's a really, like you said, low risk way to start. And what I tell folks about the different of getting started in PRIs versus grants, like they'll say, well, we're worried about our funds, we're going to lose them money. And I said, well, what's the repayment on those grants that you make?
Wonderful. And you remind me, Lisa, that not every community has its own CDFI, but as both you and Chris observed, there are regional and national CDFIs that are often willing to come into a new market area and very excited to work with a mission-driven investor like a foundation. I know we're going to wrap up in just a second. I would like to take a moment to first mention that there's also more information about CDFIs in the slide deck. But just touch on guarantees, because I do think they will be important in this economy. A guarantee can be pledged and does not have to be immediately funded. And it can enable an investee to get financing from a bank or a CDFI that might not otherwise be forthcoming. And of course, a guarantee is there in case the borrower defaults. The guarantor has to step in. Lisa, I know you've had a fair amount of experience. I believe your loss rate on guarantees is about 5%. You're
Right.
not coming in and having to repay 100% of loans.
Right. That's right. Now we'll set aside, sometimes 50%, sometimes 100%, depends upon who we're working with. We'll take it out of we'll put it away. So no, we can't spend it.
Tremendous.
But we've only had maybe one guarantee of the many that we've done called.
Wonderful. And Chris, I know that you're participating in the National Community Investment Guarantee Program, which has its own reserves and risk management. So with that, I am delighted to thank the panelists and the participants and pass it back to Lindsay Goldman.
Thank you so much. This was such a rich conversation, and it will be one of many. This is not the last time we will speak about this issue, but we are at the end of our hour. So I would love to thank Lisa, Chris, and Chris for being with us today, as well as Archstone Foundation and Grantmakers in Health. Please join us for our next webinar on July 6th. From 12 to 1, focused on older people in Ukraine and how philanthropy can provide support. Please follow us on social media and complete the brief survey on this program. Your feedback helps to improve our programming. And finally, thank you all for being with us today. Please be well.